Hi and welcome to the candlestick lesson, and we'll be looking at and focusing on 6 reversal candlesticks, and we'll run through them one by one. We'll be jumping on TradingView charts on the laptop down here. I'll screen share and we'll run through the candlestick patterns. I'll show you what a candlestick is and we'll have a walk through it and explain it. Now, as for the candlesticks that we'll be focusing on, they are reversal candlesticks. There's going to be the low test and the high test candle. There's going to be the hammer and inverse hammer or inverted hammer. There's going to be the inside bar, and there's going to be engulfing candles, tweezer candles, and doji candles. There are obviously a lot of candlestick patterns out there, but these are the 6 major ones, the 6 major reversal ones that we'll be focusing on for this particular strategies that we'll be teaching. All right, I'll explain and draw the candlesticks here on the pad and you can follow along. So firstly, let's have a look at a bullish candle. We're going to draw a green candle here. So the body of the candle, then we're going to have a wick. Now a bullish candle, it opens at the bottom of the body of the candle and closes above the open. So open, close. So if it closes above where it opens, it will be a green candle and it's called a bullish candle. Now a bearish candle, it's a downwards candle. It's going to be red. We'll draw that over here. That's the body of it. You'll have wicks. You may not have wicks. You'll have different size wicks, different size bodies. It all depends on what the market did and how the market moved. So again, on a bearish candle, it's the same thing. Bearish. And your candle, the candlestick opened here and it closed here. It closed below the opening, making it a red candlestick, making it a bearish candlestick. Okay, now firstly, let's jump on the charts here and I'll show you what a candlestick is. If we zoom in a little bit here and make it bigger for you to see, I'll have a look at this big bearish candle here, the red one. So bearish candles are normally red and bullish candles are normally green, but in my case, I made them all white with a hollow body. That's just my personal preference, but normally bullish is green, bearish is red. Now, this big candle here is bearish, meaning it opened right here on that level there. That's your opening of the candle. It made a run upwards, so that little part there is what's called the candle's wick. Then it went all the way back down throughout the time that candlestick was opened. It would have fluctuated or done whatever it did. And then at the end of this candlestick's time period, it came down, 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 went down all the way to here, which is the lower point of the wick, the bearish wick, and then came back and then closed right there. And then it jumped to the next candlestick. So that was the entire frame or pattern of that candlestick's life. And it's all displayed there. So you can actually see this candle houses data like the highest point of that candle, which on the side there you can see 0.5718, and then the opening was 0.5709, and the candle body traveled all the way down to 0.5652, closing to 0.5654. Alternatively, on TradingView, if you just hover on a candle, on the top section here, it will show you your opening, your highest point of the candle, the lowest point of the candle, and then when it closed. So if you hover on each candle, it will give that data to you. So now let's look at a bullish candle. We'll move to this one here. So when it jumped from this candlestick to this one, a new one populated, it jumped straight there. Normally, the next candlestick forms where the previous one closed, apart from when there's a market gap, and we'll talk about that another time. where the market actually gaps and a candlestick can jump lower or higher to where the previous one ended. Normally over weekends when the market has been shut for a while, or if there is like really high impact news. So bullish candlesticks. This one right here opened right here. It went on and traveled upwards all the way up to here. By the way, it could have gone either way. It could have opened here, traveled downwards, and then upwards, and then back here, or in any of those combinations. But all this is telling us that at one point in this candle's life, it reached all the way up to here, and it reached all the way down to here, but opening here, and at the end of the candle cycle, closing here. Now, how do you know when this candle has, the time frame of this candle has ended its cycle? Well, that's depending on what time frame you're viewing the charts on. So in this one, we're looking at the daily time frame. The daily time frame, meaning each one of these candles is exactly 1 day old. If we jump to the 4 hour, then every candle from the time it opened to the time it closed is 4 hours. All the way down, all the time frames. If you look at the 5-minute one, then every 5 minutes a new candle will populate. So that's the candlestick body. That's how it works. Then now we're going to look at different types of candlesticks and different patterns that all tell a story. So you can look at it as the body of the individual candle tells a story. Then there's different candlestick formations that can either single candlestick tell a pattern, or multiple ones can start forming a pattern. And then you can actually look at all of it together to start looking at market patterns and reading them as a all-in-one, kind of like your double tops, your double bottoms, and head and shoulder patterns, all of these things that we'll cover in later lessons, but I won't confuse you with that right now. So one thing to understand is the time frames within the candlesticks. We will mainly be focusing across 6 different time frames: the quarterly sometimes, mainly the monthly, the weekly, the daily, the 4-hour chart, the 1-hour chart, and the 5-minute chart. So for instance, one weekly candlestick, that one weekly candlestick will have in it 5 daily candlesticks. So 5 of them in there, because the market is open 5 days a week when you trade Forex. If it was crypto, there'd be 7 daily candlesticks within a weekly candlestick. So same goes for all the candlesticks, every time frame. You can divide it. So within one daily candlestick, you'll have 24 1-hour candlesticks. So there'll be 24 of them within that one daily. And it goes on, and you can divide it in so that you can start to see that on the higher time frames, say one of your reversal candlesticks, whether it be low test, high test, doji, whichever one, is one candlestick on the higher time frame, but on the lower time frame, it can actually be a pattern in itself. Now, I'll show you the doji candlesticks. Doji candlesticks have a small body. The open and the close of the body was very close to each other. So your market open there and your market close, the distance there, the gap there is very small, and it normally has these wicks that are much longer than the body of the candle. So it kind of looks like a spinning top. Now the reason for this is that it's because the bulls and the bears were battling and they weren't really getting anywhere. So it means ultimately that there's indecisiveness in the market. Now you can get these to show up in green or red, depending on how they closed, obviously. But that doesn't always necessarily mean much. The ultimate thing about the dojis is that there's the indecisiveness. So they push up, no one wins. They push down, no one wins. And ultimately it sort of just ends right, kind of close to where it opened. So let's jump on the charts. I'll give you a good example here of what the doji is. If you have a look at this area here, you can actually see right there is a bearish doji, a bullish doji, and a few more dojis and a whole lot of deceleration. So you can see that this indecisiveness and this deceleration here has caused this little run to the downside to happen there. Now let's have a look at the low test and high test candles. You can have bearish and bullish low tests and bearish and bullish high tests, and they'll look like this. This here is your bullish low test. This here is your bearish low test, and this here will be your bullish high test and your bearish high test. So what this means is that momentum has come in either upwards for a high test or downwards for a low test. So for a high test, you had a lot of bullish momentum come in and push the market up, and it essentially tested an area, whether it be a support and resistance or a trend line or whatever support and resistance there was that it tested, and it didn't win the battle. It went back down and closed way below the high, extreme high of that wick, that candle's wick. And it's the opposite for the low test. So low test and high test candles are a pretty strong indicator of a reversal coming, either a reversal of a trend or a turnaround in a pullback. So this candlestick opened in that level there. The bears came in and pushed it down, 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 and then they lost the battle. It came back up and it actually surpassed where it opened and closed as a bullish low test candle there. So that's a strong indication that the bulls are coming in with a lot of backup there and ready for some bullish momentum to be injected into that market there. So if we scroll back a little bit to this time frame here, you can actually see that there's a low test candle here, but it's actually a bearish low test candle. So whether it's a bearish or a bullish, it has a little bit of weight to it, but you can have either of them and it's still being a pretty significant sign of reversal. Now, the low test candle or high test candle, what it essentially means is it's testing support and resistance levels, or testing an area there that has strong support and resistance, and it's not wanting to pull, it just doesn't have the power to push through that barrier. So for example, you could have here, let's say for example, a really strong trend line that it's rejecting. You can actually have a really strong option H is a horizontal line, by the way. You can have a really strong horizontal line there that it might be rejecting. You could have a zone that it's rejecting there, so a certain price zone, for instance, that it's rejecting. You can have 50 EMAs, 20 EMAs. You could have the Fibonacci, say, retracements. You can have all these levels that it's rejecting, that it can either build up and stack your confluence, like we'll learn in the lessons to come, or if you just look at price action itself and you just look at the candlestick itself, you can see that just by looking at the candlestick itself, you already have a sign here that something's about to happen. In this case, it was just the sign of that the trend is continuing, so it's just the finishing off of the little pullback that it did. So high tests and low tests are normally either the end of a trend, indicating it's ready for a change of direction in the trend, or it's at the end at the end of a run. So over here, the trend has continued, it's made a little pullback and then continued. So it's just indicating that this little pullback has come to an end and it's ready to continue the trend of the market. So I'm not going to waste your time with an example of a bullish high test or bearish high test, because it's exactly the same, it's just opposite. It's testing the top of a market, it's testing support and resistance at a higher point instead of a lower point. So it's the exact same thing, just in reversal. You're going to be seeing them a lot. They are one of the stronger reversal candlestick patterns. And next, we'll look at the tweezer top and tweezer bottoms. Now, the easiest way for me to explain tweezer tops and tweezer bottoms are essentially it's two high tests or two low tests next to each other. So I'll draw a few combinations here to show you that it can go in a few different combinations. You can have bearish and bullish or any combination of them, and depending on what's going to happen, if it's a bearish market or a bullish market, I'll explain it on here how it will matter. So I'm quickly going to draw a few combinations here for you. You can see that there's a few different combinations of them here, and I'll explain to you which ones are the strongest in what market conditions. So for example, if you have a bullish trend, upwards trend, and it's ready to turn around and go to the downward side, bearish side, this is going to be the strongest combination. So if you now have a bearish trend and it's ready to make a reversal to the upward side, this is going to be the strongest combination. So what's happened is, say we'll look at the bullish trend up here, and it's ready to make a reversal to the downside. So you've got a bullish high test followed by a bearish high test. So prices come in, it's tested that area, bears have come in and they've started to battle, it's closed back down. Then the next candlestick, again, bulls have tried again, but now actually the bears have won further by actually closing that candle body as a bearish candle. So the bears have the upper hand in that situation. I'll show you on the charts here. I'm not going to show the opposite ends because it's the same but in reversal, but I've got an example here in mind that I'm going to show you and see if you can spot this one. For this example, look at New Zealand dollar and have a look at these tweezers here. This is what I would call the perfect tweezer setup, where this bullish run is slowing down, coming to an end here. It's a bullish high test followed by a bearish high test, forming this almost textbook tweezers up here. And this is indicating that this trend here, this bullish trend, is ready for a reversal to be turned into a bearish trend. Now, has any of you caught on that time frame there? Have you noticed that that time frame there just so happened to be an indication there of something big is about to happen? That there is the 2008-2009 recession, the global recession. So if we skip forward here in time, you can actually see that the market just crashes. So tweezer tops, tweezer bottoms, same thing. Tweezer bottoms would be the same thing, just reversed. Very powerful candlestick formations to indicate reversals. So next, let's look at an engulfing candle. So you're going to have bullish engulfing candles and bearish engulfing candles. And we'll quickly draw them. So this is going to be your bullish engulfing candle. So what that means is that this candle here, the body of this candle is bigger than the previous candle. The previous candle being a bearish candle, but the engulfing candle being a bullish engulfing candle. So it's a green one. So you remember this candle closed here, opened here. Where a candle closes, the next one opens, and this one closed here. So you can see that this candle here, the green one, the bullish engulfing candle, is completely engulfing the body of the other candle. It can swallow it up. So don't worry about wicks. We're not worrying about wicks in this instance. So how's that going to look in the market? Well, let's draw our upwards trend here. and downwards. So you can see that candle is engulfing that one, ready to go downwards now. So momentum has slowed down here. A big bullish run has come in, momentum has come in, and it's eating that little bear. So bullish pressure is being injected into this market, and it's an indication that we're going to get some bullish movement there now. So again, this one here is a bearish engulfing. This one here is a bullish engulfing. So let's jump on the chart and I'll show you a real life example. So Aussie CAD chart here, you can see that we've got a big bearish engulfing candle here. And you can see the bearish engulfing candle here is more than double this body size of the previous bullish candle. So big bearish engulfing candle here that indicated that there's bearish momentum coming into this market here. Now, you can actually see this trend here had a little pullback here, and you can see there's actually a bullish engulfing here, indicating this little pullback has come to an end and the trend is continuing up. So trend has come up, made a little pullback, and then this candle here, the bullish engulfing, was our indication that the pullback has come to an end and the trend is continuing to the upside. So you can see with this example where they come into play, and they're also an indicator that, like as you can see here, that the actual trend can come to an end and it's starting to reverse into a bearish trend here. And it's just going to be the opposite for bullish and bearish, but this is the example of what they look like. And next, we'll move on to a inside bar candlestick. So your inside bar candles essentially are just the opposite of an engulfing candle. So let me show you how it looks. Over here you have a bullish inside bar. Okay, and then the opposite goes for this one here. We have a bearish inside bar. And again, it doesn't matter about the wicks. It could have wicks, it could not have wicks. We're talking about the body size of the latest candle being smaller than the body of the previous candle. And let's have a look on the charts here for an example, a real life example. There's an example here on pound dollar on Tuesday the 1st of July 2014. You can see there we have an example of a beautiful bearish inside bar that's happened there. Now, bearish inside bars, just like every other candlestick we'll be focusing on, it helps to stack confluence like major support and resistance levels and things like that. So for example, if we had a look at this chart, we press Option H, which is your horizontal bar, you can see here, this is actually a major horizontal support and resistance level where if you stack the confluence like that, and you see that something like that, and for example, if a Fibonacci retracement worked out as well, and it also all stacked in there, and if, for example, if you had another one, say maybe for instance there was a trend here as well, that so if all the confluence stacks on top of each other like that, and you have all that support and resistance there, then it really strengthens that inside bar a lot. So again, like with all the others, the opposite of that would just be in the opposite direction, and it'll be a opposite colored candlestick. So I'm not going to go into that. You get what the inside bars are. And let's quickly have a look at the last one we'll be looking at, which is a hammer and an inverted hammer. So your hammer candlesticks, essentially, the easiest way to explain that is it's just the opposite of a low test or a high test candle. So to make it more sense, I'll show you here if we have a bearish market there and a bullish market here, your hammer candles are going to be like this. So let's jump on the charts and I'll show you a real life example. So if we look at Australian dollar, US dollar, you can have a look here and you see there, that's a hammer reversal candle. Now, the thing with hammer candles is normally they're not very strong by themselves. So you normally want to look for another one or two at least candles to confirm that something's happening. So you want to stack things like support and resistance levels, and as I said, wait for those other candlesticks to confirm. So as you can see here, you've actually got your hammer here followed by another high test bearish candle there that kind of confirmed that downwards trend starting to go downwards. So they're not very common. So the hammer candles are not very common, but you will see them every now and then. And so with the hammer candles and with the doji candles, you'd want more confirmation. It's more just a sign that the market is starting to decelerate, and then you're going to wait for that confirmation that it's going to change direction. So that's it for the candles. So there you go. We've had a look at now 6 of the main reversal candlesticks that we're going to be using in the lessons. And we're going to be, in the upcoming lessons, show how it's all going to puzzle together and how it's one piece of the strategy, and it's a very necessary piece of looking at price action. And I want you to do some homework. Go have a look at all 6 of these candlesticks, go onto the charts and just scroll through the charts and start spotting them. And eventually you just see them on the chart. They stand out to you. Almost like if I told you to go and look for only blue cars outside, you're going to see every blue car. That's it for this particular lesson. Have a good day, morning, evening, wherever you guys are in the world. And I'll see you in the next one.